Italian Pie is proud to support WYES and this episode of Wall Street Wrap-Up, and to promote the importance of financial literacy and education.
This week on Wall Street Wrap-Up, the CPI inflation numbers were released for February and came in as expected. Are the higher rates by the Federal Reserve working? More bank closures this week as SVB on the West Coast and now Signature Bank on the East Coast have been taken over by federal regulators for insufficient funds on hand. And a possible bank failure diverted by banks not buying the assets but opening accounts. $30 billion worth of deposits were added. I'm Andre Laborde. We've got these stories and more. It's Friday and it's time for Wall Street Wrap-Up. Hi, I'm Andre Laborde. Welcome to Wall Street Wrap-Up. It's St. Paddy's Day for this Friday, March 17th, 2023. The government this week released the inflation numbers for February, and it was up 0.4 of a point for the month and up 6% year over year since last February. Now, excluding food and energy, which is called core CPI, prices were up 0.5% for the month and up 5.5% for year over year. We see inflation most when we go to the grocery. Eggs are now up over 55% from last year. Butter is up almost 40% from February of last year as well. And in the energy sector, glad to say that gasoline is actually down from the same time last year. But other than that, everything else is higher, with electricity on average up almost 13%, and utilities are up over 14%. Well, coming up tonight, we're going to be talking about bank failures this week. We're talking about the economy, where to invest your money. We'll be talking with Jason Brady. Jason is president and CEO of Thornburg Investment Management with over $41 billion of assets under management. We'll be talking about SVB and Signature Bank failures, the state of the economy, and where is he telling his clients to invest for the rest of 2023. That's Jason Brady. He's coming up. So, how has your money moved this week? Well, this week, with fear of more regional bank failures and what will the Federal Reserve do next week about interest rates, the market was mixed, with energy and financials were the worst sectors for the week. Now, there was much more green on the screen this week than in other past ones. This week, the Dow Jones closed today at 31,851, down 57 points for the week. And the S&P 500, they closed today at 3916, up almost 1.5% for the week. And the NASDAQ, they closed today at 11,630, and that was up 4.3% for the week. Now, this week, a number of large banking institutions, rather than buying First Republic Bank, which was what was done in 2008, they opened accounts in the bank as well. Bank of America and JP Morgan were two of the banks that put in $5 billion each, where others, as say Goldman Sachs and Morgan Stanley and others, added between $2.5 billion and $1 billion each as depositors. So, if your money is in a regional bank, is it safe? And the answer is yes. Any FDIC-insured bank, each account is guaranteed up to $250,000. Now, if you have over that amount, you can open up another account at the same bank, or you can go to another institution to open up an account. Now, if you're a business with a federal ID tax number, the cumulative amounts at that bank are insured up to $250,000. Well, let's get to our guest tonight. Jason Brady, he's president and CEO of Thornburg Investment Management with over $41 billion of assets under management, and he's here with us tonight. Hi, Jason. Welcome to Wall Street Wrap-Up.
It's a huge pleasure. Thanks for having me.
This past week, we've been hearing a lot about SVB, Silicon Valley Bank, and there was also Signature Bank and possibly maybe more that have come and may possibly come. Do you think there are more shoes to drop when it comes to these type of small regional banks?
You know, it's pretty clear that the regulatory regime for smaller banks was and is less strong than it is for the so-called globally important financial institutions. So what you see is right now something of a flight to quality to sort of the JP Morgans and Citigroups of the world. The reality is the balance sheets of most regional banks are just fine. Is even the other names you're seeing in the news, like First Republic, don't have nearly the same degree of issue that Silicon Valley Bank had. So I don't expect this to be a significant issue, but it is pointing out some serious challenges in the regulatory regime for the United States banking system.
About 95%, and I'm talking about SVB right now, about 95% of their depositors were over $250,000. Well, FDIC has insurance up to $250,000, but now it looks like FDIC and at least senior Treasury officials are talking about insuring even those that are over $250,000, making them whole.
Largely what they're trying to do is calm a bank run. So essentially what SVB had was, as you say, a large portion of their depositors, which were very large, but really were business customers. And SVB had a niche business of lending to the tech industry. We can get to that in a second. But ultimately, what the FDIC and Treasury have come up with is that they believe that the assets of the bank will ultimately be able to make depositors whole. This makes sense. If it's not going to make depositors whole, what they've come up with is a likelihood of a banking levy on other banks, the overall banking system, as opposed to taxpayers.
If they do this levy on all the banks, that they're just going to pass this on to their clients, their customers?
We'll see. Honestly, what I think is happening is a lot of the deposit flight towards the larger banks is likely going to give those banks, a continued edge in the marketplace. So the question will be, how quickly will those banks adjust, for example, their deposit rates? What's interesting with business depositors is that they're more likely to move their money versus keep their money at the bank in search of a better deposit rate. That's what's known in the industry as deposit beta. So today, the Federal Reserve has raised front-end rates significantly, but many large banks have deposit rates that are still quite low. That wasn't true with SVB, and additionally, what happened was they had a niche customer base in the VC market and sort of the tech industry. And those companies have been under some significant cash pressure due to cash burn. So they really hit with a double whammy here as far as deposit flight's concerned.
Do you think that this, by making all depositors whole, and whether it be the FDIC and or the administration, whoever bails out those that are over 250,000 plus, do you think that will also be more inflationary?
I don't know if it'll be inflationary. My question would be, what cost in the context of the requirement of the banking system to really cause depositors to be safe without insurance? It's a real question on how well capitalized the banking system is at the regional bank level, but it's also regional banks that serve as a very important conduit for a lot of local lending. So this is a real challenge for the banking system overall. But again, I don't think SVB is representative of bank balance sheets in general, even a significant number. What I think is that SVB is representative less of banking trouble and more of specific challenges within the tech ecosystem.
Would you say that maybe small regional banks are a good buy as a sector right now when it comes to picking of stocks?
Just lately, they've rallied quite significantly off some lows. And like I said, I think there's going to be deposit flight towards the sort of larger banks. That said, a number of these franchises are very, very cheap today. And if you dig into the fundamentals, there are names where the challenges that SVB had, which is really a duration mismatch, right? Banks borrowing short and lending long. SVB did that dramatically and then had a bank run on their deposits.
By the FDIC going ahead and insuring those depositors that are even more than $250,000, do you think that in a way of saying you're rewarding of bad behavior? I mean, what says a bank then won't say, well, just swing for the fences, because you know in the back of your mind that the government's going to bail you out? As you know, with capitalism, it's a risk reward. You risk, and there's a possibility of a reward later. But if the government will back you.
A lot of folks concerned that there wasn't a so-called perp walk after 2008. And as you may recall, regulators allowed Lehman Brothers to fail, the belief that they couldn't back every single financial institution, regardless of their size. Quickly, they seemed to realize, and now with the benefit of hindsight and a lot of memoirs, we can take a little clearer look, that that was a mistake because it created so many more problems. I think what you're likely to see with Silicon Valley Bank is, of course, the management's been fired, but you're also starting to see rumblings of legal action and potential criminal action. So the question really will be if that sort of threat of criminal action is enough to change the behavior of bank executives. I would simply ask the question of, it's not just bank executives here, it's also the state of bank regulation.
Do you think that also the Federal Reserve, because with them raising rates from early last year up to now and coming up to next week as well too, because they're raising rates so much, which was part of the reason why SVB was investing in treasuries the way they were, they got caught in a squeeze. Do you think that the Federal Reserve has some kind of maybe culpability?
I think the Federal Reserve is a cause, that their actions are a cause. But to say that they would imply that the Federal Reserve's job is to be in charge of every bank. Now, they are a bank regulator, so in that sense, yes. But the idea that the Federal Reserve shouldn't take the actions on a rate policy basis that they need to in order to ensure financial stability and look for full employment, I think is really challenging. The financial stability or the price stability of inflation has been at least as much of a challenge for markets as any kind of bank issue. All we need to do is look at how much, for example, the 2-year Treasury has moved in the last year. It's moved 5%. Now back down this week, went from 5 to below 4 and now in the mid-4s. But that movement's incredible. But ultimately, the overall move from 0 to 5 is going to be destabilizing no matter what happens. Every time the Federal Reserve raises rates like this, they break something. And actually, that's kind of the point. That's what they're looking to do. Because what they're looking to do is slow the economy down, given the inflationary environment we see.
The Federal Reserve is going to have their meeting next week to see whether or not they're going to raise rates. And before all this happened with SVB, there was a thought of even raising 50 basis points. Now the question is, do you think that they're going to even raise rates for next week, or do you think they're going to do 25 basis points?
I think they're going to do 25 basis points. We got a couple of pretty important data points. One was the most recent jobs figures, and one was the most recent CPI figures. On the jobs front, it was an okay, even good report, but the underlying details were a little bit weak. A lot of the job creation was in lower paying industries, particularly leisure and hospitality, which meant that average hourly earnings rises were less. With regard to CPI, we saw some continued slowdown on CPI. The big issue there is that while goods inflation has actually become pretty de minimis, services inflation continues to rise. So on one hand, you have these reports with a bit of a mixed picture, but ultimately still inflationary and challenging. On the other hand, you have this SVP news. I would tell you that the Federal Reserve believes that they're going to solve the SVP problem with more of a macroprudential approach, regulation, the FDIC and Treasury actions that you talked about. But the inflationary picture still needs to be dealt with, and the Fed cannot lose credibility on that side. Otherwise, there's really no point to the whole exercise.
Yeah. And I would imagine, as to what you're saying, is if they decide to do no rate hike for next week, then that would give the wrong signal and that there would be more dovish. So they really want to emphasize that they really want to get the inflation under control because of, as you say, the CPI numbers that came out this week and the job numbers that came out last week, right? Yeah.
That's right. The Fed is really is in a performance today, right? They're really trying to, in a certain sense, give markets and individuals confidence that inflation is not going to be a runaway problem, that they're on the job. While it is absolutely the case that the Silicon Valley Bank blowup would not have occurred with this significant rate rise, that really cannot deter them from a broader sense of financial stability with regard to inflation. And what we see today is the market trying to suss out what will the terminal rate be and when will that occur? At what point will the Fed be done? 3 weeks ago, it felt like they were never going to be done. This week, the market started to price in that they were already done. I think the reality is somewhere in the middle.
Do you think there will be a pause coming up soon in the next 6 weeks or so after, or possibly another one and then a pause?
So the Fed is absolutely in this mode of being, quote, data dependent. And I'll tell you, that's a pretty dangerous place to be when you have policy actions that have a, quote unquote, long and variable lag. In other words, the rate rises that they started doing, frankly, just a year ago, are only really starting to hit the economy, witness the SVB debacle. So they're data dependent. What they will say is that they have a number of additional data points until they have to make that decision. What I'll tell you is that the Fed is pretty bad at figuring out exactly what the right rate level is. Essentially what they're doing, it's like they're in the shower in a hotel, right? You show up and you're not sure how hot the water is going to be, so you turn it on, you hop in, and it's too hot, and then it's too cold, and it's too hot, and it's too cold. That's pretty much the Fed setting rate policy. So we'll see. I think that they will continue to raise rates, but ultimately their history is such that the distance between their last rate rise and their first rate cut is not very long.
Now, at one time, you were thinking that energy prices were going to be going lower. And I'm curious, do you still think that, and based on the CPI numbers that came out this week, do you still think energy prices are going to go lower? And if you do you think that maybe the oil and gas sector, would that be a good area to be investing in?
Well, Andre, I'll tell you that over the last sort of several months, what we have seen is a calming of energy prices. So we've seen that occur. At this point, I think energy markets are pretty well contemplating that we're not going to get a huge increase in growth over the next short period of time. What I'll also say, though, is that we're seeing a bit of China reopening, and ultimately that's cause for some notable demand pressure to the upside. If that continues, the slowdown that we're seeing in the U.S. is going to be overwhelmed by demand increases outside the U.S. So ultimately, I think we're at a pretty good equilibrium here now that energy prices have come down. One of the names that we really like, which is Total Energy, is not just a good producer at a good price, but also has a pretty significant renewables portfolio. So a good transition energy name as well.
Are you favoring, especially like with your clients, maybe international stocks?
I think what we're seeing is that outside the U.S., there is always, or has been for quite some time, a discount for international stocks versus U.S. stocks. And part of the reason is that the U.S. generally has a much higher weighting towards technology or names that tend to have a higher earnings multiple, a PE multiple. Even adjusting for that, what you see is that international markets have been gotten pretty cheap. At the very least, I'd say that a lot of U.S. investors have a way over-indexed to domestic stocks versus global stocks.
If we're starting to see maybe the light at the end of the tunnel, what are your thoughts about technology stocks?
I think tech stocks have, first of all, the tech industry has become very large and it's quite diverse, right? So a lot of money-losing tech is very different than, Apple, which itself is very different than Microsoft, right? So I think there's a lot of diversity there. That said, what you've seen is tech businesses start to struggle from a multiple standpoint as rates have risen because the cost of money has become more expensive. When you look at SVB, one of the challenges they seem to be having, at least from early reports, in selling the bank is that a lot of their assets are pointing towards the VC or tech industry, and folks are having trouble valuing that because there aren't a lot of assets and there's not a lot of cash flow. What I would say is that tech has done better in a low-rate environment, but the process of getting from higher rates today to lower rates sometime in the future is a process that ultimately will be very damaging for names that are really required to come up with their own capital, really required to show some profitability. And I think that process will be one that'll be winnowing the money-losing tech industry pretty dramatically. So ultimately, SVB, again, is less about the banking industry, although certainly a duration mismatch, and more a kind of canary in the coal mine in the tech lending space.
Without having a Silicon Valley bank anymore, to have that void with the with the venture capitalist investors, do you think there will be another bank, regional bank, or somebody that will then step in and fill that empty void?
It's probably going to end up being a series of banks, really large multinational banks. So, once bitten, twice shy, I think folks will move a lot of their business to the JP Morgans and Citis of the world. The real question is, as we've seen over the last 15 years, banks being somewhat disintermediated from lending, the question is now a lot of these lenders to tech are private credit players. They're not actually banks at all. SVB was a more traditional banking player. But the folks that are looking at the lending platform for SVB are Apollo and Ares and folks that aren't banks at all. That's where the lending is going to continue to come from. And that's going to be outside the purview of the FDIC and frankly, in a lot of ways, outside the purview of the Fed. So,
when we talked about China before, there's a lot of maybe possibly black swans coming up maybe toward the end of this year, maybe next year. Xi Jinping has just gotten his third term. This week, there was a U.S. drone crashed with a Russian jet. We don't know about how Iran is going to be doing and whether or not, we're talking about with nuclear weapons and as far as with Israel. Do you see black swans or what's known as black swans coming up maybe toward this year or might be next year?
Kind of the definition of a black swan is you don't know what it is. When we looked at the market this week as one example of a quote-unquote black swan, the 2-year Treasury moved in one day by one measure by 8 standard deviations. To give you a sense of that, a 7 standard deviation event occurs approximately 4 times in the Earth's history. And so 8 is really just off the measure of time scale. So the reality in this market and frankly in financial markets everywhere is that the 1,000-year flood happens essentially every few years. And we have to be ready for that and understand that and be robust in our risk management process and robust and frankly in a lot of ways simple and straightforward in how we manage portfolios. So that said, a lot of the valuations in names that have some exposure to that, Taiwan Semiconductor being an example, contemplate a lot of that potential geopolitical risk. So for us, it's about understanding that risk, but also putting it together in portfolios in a way where one challenge or issue isn't going to entirely sink the ship, but rather we're contemplating that there are things that we don't know, and we're going to be robust in our risk management process around that. And that works for individual investors as well.
Sure. Do you think that a recession is still, whether it be imminent or a recession coming, is still possible?
Absolutely, it's possible. And I would say it's even likely. So we see a number of cyclical measures that pre-stage recession. One is an index of leading economic indicators, which has turned negative. When it's turned as negative as it is, we've always had a recession. Second is Institute of Supply and Manufacturing measure of strength of manufacturing. When it's turned as negative as is, we've always had recession. The question is this time different? I think it's different a little bit because the pandemic really has changed a lot with regard to financial markets and caused a lot of imbalances. But then 2, well, if it's going to happen, the real question is when. My best guess is that we're going to start to see a slowdown in economic activity, real economic activity, i.e. after inflation, sometime towards the end of this year. And the real question is just how deep or difficult that might be.
If we have a recession toward the end of this year, or possibly soon, and whether it be hard or a soft landing, do you think that, would you be more bullish on bonds right now?
Well, bonds represent in nominal terms the best value that we've seen since essentially before the financial crisis. So today what investors have is an opportunity for fixed income to actually fulfill a role that should be in their portfolios that we haven't seen since 2007. And that is both an element of income and an element of ballast to the risky assets to your portfolio. So what we saw this week and last week was when stocks fell, bonds actually went up in price. And then when you had a little bit of normalization, it went the opposite way. That's the best case scenario for investors, to have either very low or uncorrelated assets that both provide some kind of return. So it's a much, much better environment today. We had to go through a terrible 2022 to get here. But here we are, and it's very much more interesting for investors.
What's the best investment advice were you ever given?
I think the best investment advice was enjoy the process, enjoy the grind. I think a lot of investors look to try to get rich quick, or to sort of, hey, I got to get the endorphin high of getting something right and calling exactly the bottom. You know, I've bought the bottom a lot of times, but I've never only bought the bottom. And ultimately, you don't get judged on one trade that you did or 1 year. This is really quite a long game. And so you better enjoy, grind it out in good years and bad. So, you know, for us at Thornburg, the bad years are simply an opportunity for us to really showcase our ability to serve clients. And the good years, the ones that are actually boring as a portfolio manager, those are the years that we're able to grow our business. And that's just part of the grind.
Jason, I couldn't agree more. It's the journey, not the destination. I appreciate it. Jason, I hope you come back.
That was a huge pleasure. I'd love to come back. Thanks for the time.
Thanks, Jason. Well, if you've got a question or a comment about the show, we'd love to hear from you. Make it concise, make it pithy, and write us. And notice the new email address at andre@benacapital.com. Well, let's take a look at the markets heading into next week. But first, what was the first U.S. coin to have "In God We Trust" engraved on it? We've got the answer in just a moment. Well, what was the first U.S. coin to have "In God We Trust" engraved on it? The 2-cent coin of 1864. And finally, for a Wall Street wrap-up, Chick-fil-A is heading to Europe and Asia. The number 3 fast food restaurant in the United States is now spending $1 billion to expand their Eat More Chicken to Europe and to Asia by 2026. And TikTok is in talks with potential buyers as the U.S. government presses for a ban on the Chinese-owned social media company. And the NBA Charlotte Hornets owner Michael Jordan is in talks to sell a majority stake of the NBA team. ESPN is reporting that when the sale is completed, Jordan will be still minority owner of the franchise. But according to Forbes magazine, the sports team is valued at $1.7 billion, and Jordan has owned the Hornets since 2010. And that's a wrap-up on Wall Street Wrap-Up. Join me next week when my guest is going to be Phil Orlando. Phil is the Chief Market Equity Strategist at Federated Hermes. He'll tell us where he's advising his clients to invest. That's next week. All next week. That's our show for this Friday, March 17th, 2023. My thanks to Jason Brady for joining us this evening, but especially for you. I want to thank you for allowing us into your homes this evening. Have a fun weekend ahead with the ones you love and a productive week as well. I'll see you next week. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde, and remember, money never sleeps. Good night.
Italian Pie is proud to support WYES and this episode of Wall Street Wrap-Up, and to promote the importance of financial literacy and education.